With the Federal Reserve now just 6 days away from announcing its next move on interest rates, the jobs picture is front and center. Should that be, though, what investors focus on as well? To the Floor Show. Joining me now, Charles Schwab, Managing Director and Chief Investment Strategist, Liz Ann Sonders. Liz Ann, not going to lie, this morning I was all ready to go with the Here Comes Santa Claus rally. Everything was in the green. But look, as we see the labor market grinding more slowly, how closely are you watching the labor market to gauge where the stock market might go? And how is that playing into your investment strategy right now?
So I don't know that I would put a direct line from the labor market to the stock market. It's a component of what drives the economy that ultimately feeds into the market. But where I think the labor market is most important now, and this is how it ties to the stock market, is Fed policy. And you have been seeing a little bit of shifts up and down in terms of market-based probabilities of what the Fed will do at the December FOMC meeting. But they have made it clear that they're not turning a blind eye to the inflation side of their mandate, but it seems like the trigger for moves on the part of the Fed is a little bit more focused on the labor market. So that's where the needle is moving.
And so I guess the next question would be, what are you watching most closely that's guiding what you feel is the best way for our investor audience to position their portfolios?
Well, I think this is an environment of rapid rotation, certainly under the surface. I think we're starting to see a breakdown in some of the narratives that have defined performance. You know, one of the things I think about heading into 2026 is we're likely to see less of an obsessive focus on a cohort like the Magnificent Seven. Only 2 out of the 7 stocks are outperforming the S&P this year. None of them are even in the top 20 best performers in the S&P this year. They're not even all direct AI plays. So I think we're starting to break down this notion that you can just have this narrative-driven market and find these monoliths that are a play on those narratives and, you know, set it and forget it. We're starting to see a breakdown. We're seeing more dispersion across and within sectors. We're seeing leadership changes that happen a bit more rapidly, a lot of rotation under the surface, which is actually establishing some opportunities for investors in areas outside of just that, you know, prior very small handful of stocks that were leading.
Well, if you look at the top S&P performers this year, everything from Robinhood, Western Digital, Seagate, Micron, except for Newmont, everything is in tech. So let's get our viewers sort of ahead of the curve here. What do you recommend at this moment that you're talking to the Schwab clients about when it comes to exactly the better places to maybe portion some of that tech-heavy part of their portfolio elsewhere?
Well, let me preface the answer a little bit. One of the key messages we've been imparting to investors is be very mindful of not letting concentration become a problem in your own portfolio. We know it exists in the indexes. That's the nature of cap-weighted indexes. But I think one of the mistakes that investors are making is they're conflating price performance of stocks with contribution to cap-weighted index returns. So let me give an example. NVIDIA is still the #1 contributor to S&P returns year to date. That's, though, a function of the multiplier of its cap size. When you have a capitalization-weighted index, it's the price performance multiplied by the capitalization size equals the contribution to overall returns. NVIDIA is #1 on a year-to-date basis in terms of contribution. It's ranked 80th in terms of price performance, meaning there's 79 stocks in the S&P outperforming NVIDIA, even though it's the #1 contributor. Too many investors conflate the two, and they think the only way I can do well in the market or beat the S&P is to be in those names in a similar concentration. That's an institutional problem. That is not an individual investor problem. So there's lots of other opportunities, even within the tech sphere, wanting to stay engaged with AI. You don't have to just be in the sort of these preconceived notion groupings of stocks. Healthcare has been an interesting area that has taken on some leadership. We think that there's going to be a broadening out, but that it'll happen in fits and starts, but that you want to be more broad and open-minded in thinking about where to find opportunities. Get away from those narrative-driven, preconceived notion cohorts of stocks.
To the point of that, the Russell 2000, I mean, this is really looking like its moment. It has had some banger couple of sessions here, double-digit points moving much, much higher. And arguably, they would be the ones the small and mid caps to benefit the most if there is another rate cut, because small and mid cap companies tend to borrow a lot of money. So is that a place that you look at and say, okay, finally? I mean, the 1 week picture looks great, up 2.6%. It's beating everybody else. But the Russell, year after year, everybody gets all excited and says, now's the Russell's moment, and it doesn't quite get there.
Well, let me apply the be careful about monoliths to the Russell too. The Russell doesn't quite have 2,000 stocks in it. It's got a little bit less than that.
Yep.
But to say I like or don't like small caps, I don't think is at all helpful advice. Now, I will say that what's happened year to date is that the unprofitable stocks, the 40% of the Russell that's unprofitable, those stocks have been handily outperforming the 58% that are profitable. By the way, the other 2% are stocks that don't provide earnings, so you can't get them. What I would say about that is fade, to use trader lingo, fade the lower quality, unprofitable leadership, but lean into where you've got that profitability. So I think factor-based investing, which means investing based on characteristics, looking for decent earnings profile, being mindful of valuation, looking for balance sheet strength, non-zombie companies that have sufficient cash flow to pay interest on their debt. That's the way to think about small caps, not as a monolith. And know that sometimes the outperformance can come way down the quality spectrum, which is what has happened this year. I think you want to lean away from that type of outperformance.
That is such deep and important advice, because people just simply buy an index. And it feels like that is something that might not particularly work when it comes to the Russell. You've got to be a lot more sort of focused there, correct?
Right. Yes, and buying the index is fine to some degree. The thing you have to be mindful of when buying, say, an S&P index is that you are buying the concentration embedded in that index. The fact that you've got, the 10 largest stocks accounting for 40% of the index. So do know that taking that passive approach is good in the sense that you get diversification. You're not getting the kind of diversification you have at times past, because the concentration is heavier now than it ever has been in the past.
Really quick, I know we don't all have high-powered telescopes to see way down the road here, but do you expect that we'll see double-digit gains percentage-wise? Don't say percentage-wise. My mom would kill me. When it comes to the markets next year, again, we've seen it already 3 years in a row.
We don't do year-end price targets and forecasting. I think that's a fool's errand. No one can do it well. Anyone that says they can is just claiming that they can. I don't think that's the way to think about investing. I think next year is probably going to be a choppier year. It could still grind higher, but I think it's going to be doing that with a bit more volatility. That's typical in a midterm election year, and especially given the lead-in to the midterm election year is one of better than normal exposure. So that would be my best sort of framework to think about next year, without trying to say, here's the percentage gain the S&P is going to have. I don't know the answer to that. Nobody does.
Well, in the end, long-term investing ends up paying off in many ways. Liz Ann, happy holidays. Great to see you.
You too, Liz. Good to see you too.
Thanks so much.